Welcome everyone to this month's executive briefing. We will cover financial clarity advantage and making your numbers irresistible. And our guests today, Charlie and Jerry, they will be giving us some professional and expert insight into getting financial clarity. So they are our guest panelists, and Michael is our one of our strategic partners. He's also on the panel, and those three will be giving us some expert insight that is invaluable, and it aligns very well with what eXitSystems does. And my name is Charles Dentz. I am the founder and CEO of eXitSystems, and we're glad you're here joining us. I will be the moderator. So next, what I'd like to do is just to share just a quick background on eXitSystems. eXitSystems is a conglomerate, an ecosystem of 5 partner companies that have come together to offer transformational exit planning and exit strategies for the mid-market industry. Our focus is on growth and scaling, and with that, there is this additional benefit of preparing for an exit, preparing to sell your company, to pass down your company, whatever that may be. We make sure that that preparation is in place so that when it's time to make a deal, you're completely ready and comfortable with what's in front of you. So what eXitSystems does, and I'll share my screen. And what eXitSystems does, we focus on really 5 core areas. Those are growth and scalability, leadership and team, efficiency and systems, financial health, and exit and wealth. And today, the focus is on financial health. And certainly that bleeds into other areas as well, but today's focus will be on financial health. And then I would like to also share that eXitSystems is built around increasing value around 18 integrated value levers. And these value levers, we believe we can accelerate your growth by implementing and executing one lever at a time. And what happens is that, just like in a financial situation, compounding occurs. So this compounded growth and acceleration really increases your value exponentially. And that's what we're here to do, is to basically to make sure that those levers are addressed, and these levers are what buyers ultimately are intrigued by or attracted by. So we want to make sure that your company is as attractive as possible. So with that, I would like for Jerry and Charlie and Michael to introduce themselves, and then we will begin with that part of our executive briefing.
Thank you, Charles. I want to thank you and your team for allowing me to participate in today's program. I've spent the last 28 years in financial services, providing financial education and literacy to business owners and their executives. Much of the last 5 years focusing specifically on business owners' exit strategies. Prior to that, I worked very closely with CFOs and purchasing agents, supporting the business travel and corporate card expense strategies. The last 15 years of that was with American Express. So thank you for the opportunity, and happy to be here.
Thank you.
Thanks. Mirroring what Charlie said, we really appreciate the opportunity. Charlie and I have been working together the last 5 years, focusing on exit planning and exit strategies for business owners. I've also been involved as a financial advisor for about 30 years. Financial literacy is a big focus, and it starts from a protection first philosophy that I've applied and that Charlie and I apply across the board. So we're very happy to be here today to share some ideas.
Perfect. Michael.
Hey everyone, Michael Neal. Charles, Jerry, nice to meet you. Charles, great to be back on a panel again. You know, these expert briefings that you do every month add so much value to the community for those that are live now and for those that are watching whenever they can. That's the benefit of recordings, right? I'm a strategic partner in a business called Schooley Mitchell. We are North America's largest expense reduction consultants, and we're a proud partner of eXitSystems. As Charlie mentioned, they focus on 18 different levers. Where we hit in are a number of those levers related to efficiency, financial clarity, which is a topic today, as well as significantly boosting EBITDA. And we do that by reducing a company's core operating business expenses. Not everything, but just a narrow slice of it. Look forward to learning from you today, Charlie and Jerry.
Excellent.
Thanks, Michael.
All right, so it's your show, Charlie and Jerry. You guys take it away.
All right, thank you, Charles. As Charles mentioned, we're going to talk today about the financial clarity advantage and making your numbers irresistible. All right. One of the questions that we frequently hear is, how do strategic buyers evaluate financial statements for red flags and deal breakers? One area is retirement plans. Many buyers overlook detailed analysis when it comes to defined benefit plans and defined contribution plans. These plans, if they're underfunded, can be a significant red flag. Also, improper structure or funding among C-suites or other key employees in business agreements can leave a huge liability in the event of a death or disability of one of those key people. We also see a lot in the non-qualified deferred comp space that is improperly funded, creating huge liabilities. Another question that comes up frequently is, what separates clean books from truly decision-ready financials? It's very simple. It's full transparency. We don't like to make the buyer dig for the numbers, dig too deep for the numbers. We have many strategic relationships with CPAs around the country, many of whom support our clients. And they know debits and credits very well and do an excellent job at tax reporting and filing tax returns. But if you're in an exit situation, we suggest you engage a specialist who can compile the necessary data the way the buyer wants to see it, okay? Several fractional CFO firms are specialists in this area, and we have strong relationships with several of those firms that specialize in just that. Another question that comes up frequently is, what are some common reporting gaps that we can trust and reduce valuation? Once again, it's about full transparency, both with yourself as the business owner and the financial books. Report all the numbers. How many times have we seen a business owner look for a number that's maybe 5, 6, 7, 8 times EBITDA, but the sales don't reflect that? Why? Because there's a lot of cash sales going on here. If you want to obtain full value for your business, then you got to show all the numbers. How do you leverage financial visibility as a competitive edge during due diligence? That's another question that we get very frequently here. Well, sometimes plain vanilla benefits, things like 401k plans, might not take full advantage of the tax code. Anybody know what I'm talking about here? Okay.
It's that hidden value that gets overlooked by generalists, if you will.
Yep. We look to see if the company is utilizing what we refer to as overlooked sections in the tax code. I'll give you a couple of examples of what we're talking about here. There's a program that can provide both tax savings to the employer and additional benefits to the employees at no additional cost to anybody. You take a company with 100 employees, that company can save $57,000 on average in payroll taxes per year. And that savings is actually seen immediately each month when they're cutting their payroll. Those employees can gain an additional $1,800 on average per year in additional benefits at no cost. Things that health insurance won't pay for, or that they don't have access to, maybe because it's not offered at the company. Things like long-term disability, life insurance, a critical accident, hospital indemnity, credit protection, the list goes on. And these are complementary benefits that are all provided through this overlooked section of the tax code program that focuses on just that, saving the company money and adding additional benefits to the employees at no additional cost.
One of the things that Charlie and I have come to appreciate is that when a buyer meets an owner and the owner communicates through the programs that they're using, that they care both about their bottom line, but about their employees, about the human capital, that starts to communicate a different value. And it's one that you don't necessarily see it on the balance sheet or in the financial statements, but it creates what we sometimes refer to as a transparency mindset. And when a prospective buyer sees that the owner is taking action in those ways, it creates a different engagement. And that's the kind of engagement that we've been able to help some business owners make that shift. And it's, again, hard to quantify, but very meaningful.
Yeah, I can really appreciate that, because what it shows the buyer is that owner, that founder, that executive team, they care about their employees. And so ultimately what a buyer is buying, not only are they buying IP, they may be buying data, customer base, all of those things, but they're also buying the employees. And those employees, if they've been treated well, then they're probably also going to transition well to the new ownership team.
That's a great point, Charles, and we're going to talk about this in a minute. I'll give you a couple additional examples of how this is relevant in a second, but we've been around a lot of advisors in the exit planning space, as you probably very well know and heard from other key people. The top 3 reasons why a deal doesn't go through, no matter who does the presentation or who's pulling the analysis, is usually one of 3 things. The business owner's not ready to let go of the steering wheel, okay, in a privately held business. The C-suite is looking over their shoulders, or the key members of that organization are looking over their shoulders to see who's coming in to replace them, because I don't care how quiet you keep the deal, the word gets out. Every industry's got its own little pipeline. And if the C-suite or key management people are not secure, they're looking over their shoulder, especially in a case when maybe a private equity is on the table to take over the company. The other reason a deal doesn't go through is kind of a fallout of the first 2, and that's tanking financials. Because when the C-suite's not comfortable or the key management's not comfortable, financials usually suffer. So one of those 3 reasons is usually why a deal doesn't go through, and we've heard that consistently for the past 5 years from every sector of the marketplace, from accountants to attorneys to business brokers to M&A to P&E guys. And that's really key. So some of these strategies can help solidify not only the C-suite and the management, but reduce the possibility or the chance of the deal not closing.
Perfect.
2 other examples of plain vanilla. I'm sorry, you had a question, Charles?
Yeah, I want to, and I get and allow you to continue with your plain vanilla. Well, do that first, and I have another question, kind of a hidden question.
No problem. So the other area that we like to talk about is are they applying leverage to secure that key man protection or fund that buy-sell agreement, as we talked about a moment ago, or even enhance their own retirement income for executives or the business owners? That's a strategy. Everybody heard about leverage before when it comes to mortgages and buying a house. If you're going to buy the $2 million house, are you paying cash for it, or are you going to put 10 or 20% down and get a mortgage? All you're doing is applying leverage, right? You're getting the bank to finance that purchase of that home. Well, applying leverage to retirement plans can significantly supercharge them and secure them at a much more reasonable cost, all with increased benefits, and most of these have 0 risk. There's no loan agreements or documents to sign, etc. The third issue that we hear a lot about when it comes to business owners retiring, they're looking at maybe it's their 401k or their savings plan or whatever they've saved up, and they might have $3, $4, $5, $6 million, whatever it is. But when they start to look at what the tax consequences are, they realize that number's been cut significantly. So we have strategies to reduce, we've seen strategies applied to reduce the taxes on that qualified money by up to 30 to 40%, which lead to significant savings on their Medicare premiums and these mandatory taxes in retirement that the government has instituted, known as IRMA. So again, those are strategies that apply not only while the business is in play, but when the business owner and his executives have exited.
It really, and you know what, Charles, that really touches on that exit and wealth component of eXitSystems' overall strategies and approach.
Yeah, for sure.
Yeah.
You know, as you guys are talking, something kind of resonates with me that, you know, all of this, there are numbers connected to everything you're talking about. What happens when the founder, the owners, the executive team, the way that they view their numbers, what is the difference in the way that they view the numbers and the way buyers interpret the numbers?
Great question.
Okay.
Go ahead, Jerry.
Well, so the first thing for me that comes to mind is what are the hidden liabilities that exist in the company behind the balance sheet? So agreements that were reached, non-qualified deferred comp, or a retirement plan, not a defined contribution plan like a 401k, but a defined benefit plan or cash balance plan. Are there liabilities that the owner's going to take on, the new owner will take on from the old owner? So the current owner is trying to create as much value in the business and for the business. The buyer wants to make sure that what they're acquiring doesn't come with it beyond the purchase price, these hidden liabilities that the current owner may not have accounted for accurately. I mean, one of the things that Charles and I focus on all the time is making sure that owners understand that there are a number of strategies available to be able to achieve a certain result, and make sure that they have clarity around how those strategies actually work, not just in this year and next year from a tax savings standpoint, but in terms of what the exit strategies are down the road. And those choices have an impact on what I keep referring to as the hidden liability or the unfunded liabilities that exist. So I mentioned the transparency mindset, and we're talking about the owner having it. Well, we as advisors need to have a transparency mindset. We need not to get locked in to one particular strategy or two, and make sure that we're providing an owner with the full range of options available so that they make good choices, has effect on the bottom line, has effect on the sale, and not kind of buttonhole. In our industry, on our side of the business, in our industry, there are a lot of advisors, Charlie and I talk about it all the time, that are kind of one-trick ponies. One good idea comes along, it's the hot idea, that's the idea that they present all the time to everyone, whether it fits or not. And we've taken the position that we're going to provide full transparency to what the different options are. So when we work with business owners, and they're giving us the opportunity to help them engage in that transparency mindset, that enables the future buyer to be able to come in and not just see clean books, but be talking to an owner who makes it clear that they've done things the right way for themselves and for their human capital in the business.
Nice. So you guys have additional points?
We got one more point here,
Okay.
Charles. And just to close this out is perfect segue, Jerry. You almost knew that this was coming.
Did I?
We finish each other's sentences, Charles, so many times because we're thinking alike.
Like a mature married couple, right?
Oh yeah.
Yes.
How do advisors help companies prepare for a successful exit by dialing in the reporting dashboard and forecast. It's very simple. It's focusing on the transition of the business owner, not the transaction. There's only two letters that separate the solution from the problem. The problem is the transaction. As Jerry pointed out, the one-trick ponies are in there. Whatever their sector is, they just want to do their job and get out and get paid and get out. Most of the times, if you focus on the business owner in the transition and moving that wealth from the business owner's business balance sheet to his personal balance sheet and transition with him what he or she is going to do in retirement, it takes the pressure off of them wanting to let go of the steering wheel, and the deal closes a lot better. And that's the transparency part that we focus on with the business owner. And we have open architecture, as Jerry said, to provide any solution with any potential company or strategic partner out there in the country. So that gives us the transparency and the open architecture to do it. So
nice. Michael, you have any input, thoughts?
Yeah, a question for you guys. Thank you for all the value you shared. Great stuff, particularly those practical and tactical steps that business owners should consider, particularly on the transparency and exploring the vanilla aspects of it. How have the two of you overcome what we sometimes hear at eXitSystems as the typical business owner's healthy skepticism of using outside resources to prepare versus them saying, well, we could do this ourselves. We're fine, we're good enough. I don't necessarily want to go down this route. How have you been able to, in your side of the exit business, overcome those, somewhat early roadblocks, road bumps, healthy doses of skepticism?
one of the ways I know has worked for me is, as we were saying before, we become the advisor and not the salesperson in the relationship. If we're the advisor and we bring their advisors that they already have in their inner circle together, whether it's the accountant, the attorney, whoever it is, and we don't try to overcome those people, but we work with them, not against them. We're not there for one part of the transaction. We're there for the business owner in the transition as an advisor. And when we're presenting ourselves as the advisor, we're much more well received than the individuals that are there as a salesperson in whatever sector they represent.
Got it. That's helpful. Thank you, Charles.
The challenge that we all face is, particularly if it's a new relationship, is this somebody whose mindset is open to seeing and hearing that there might be a different way or a different approach. And the sooner we can ascertain that they're not, the sooner that, frankly, we can move on to the next opportunity to have a conversation. Forcing someone who doesn't want to change, trying to force somebody who has had a particular accountant relationship and an attorney relationship for the last 25 years and engages really in no other outside relationships and does it all themselves. If they're not seeing that it's time to make that shift or change, the sooner we can identify that they're not open to it, the better off it is for us and frankly for them, so that we're not wasting their time. And as Charlie noted, what we attempt to do when there's an introduction and a conversation is to, if we can, to identify one particular opportunity where we can lend some help and some assistance, or to help to point out one or two areas where whatever they're doing may not be, to use the term, state of the art, or the most recent strategies that are available, to attempt to engage them in a conversation and an opportunity to begin to help them. Once we can do that with one particular issue or problem, then it starts to open up the door. And frankly, the reason that we were so excited to be part of this presentation and to be engaged in the conversations with eXitSystems is once we have that opening, then it's the opportunity to start to bring in partners who are like-minded and can add value. And so everyone on the team is focused on helping the business owner transition. And no one on the team is focused on a particular transaction. Then things start to happen. But I think the first step, Michael, to come back to the initial question is, are they open to a conversation or not? Because if they're not, I want to move on to the next person who might be.
Got it. Thank you.
And I love that response. I really do love that response because it is focused on the right things, not trying to force a square peg into a round hole. But you're really looking at what's best for both parties. And I really appreciate that. And our time is, we're at the end, but I would be remiss in not asking one last question. If you guys have a moment to do that?
Sure.
Sure.
So with eXitSystems, we have a big focus on creating real-time dashboards using AI to present data, KPIs, metrics, et cetera. In your experience, what are the key metrics and reporting structures that immediately give buyers confidence in the business acquisition?
Great question. Depends on the industry, I think, Charles. We've seen and worked with several partners who have created preliminary evaluations for companies. It might be sales in one industry, it might be revenue in another, it might be customer percentages of what percentage of their total revenue is in one customer base or another. I had a client a few years ago who had 90% of his revenue with one customer. He lost that customer, he went bankrupt, obviously.
Yeah.
So I think the metrics depend on the industry. Now, we've been working with several medical providers right now with their practices and looking for a transition. I've had some construction and contracting companies looking at the same situation. I think the metrics vary by industry.
Got you. So how important is it for the founder or the owner to identify what those important metrics are as it relates to selling their company?
I think it's critical, and that's why we try to make one of our first steps with the relationship is to give them a preliminary evaluation. It gives them the different metrics and see where they are and see which ones they have to focus on to be able to have a successful transition or a successful exit. That's one of the, we have a strategic partnership with Nationwide who's helping us provide some of that data. They have national, some of those reports because they have national data on different industries.
Nice.
And Charles, I would say from my end, where we
Yes.
help businesses look at their expenses, we help get their house in order. I'm sure all of us have worked with some clients on the exit side. How long are your vendor relationships for? How long are you working with your waste provider? How long are you working with your telecom provider? What are you paying your uniforms provider? What are you paying for merchant card processing? Oh, and by the way, do you have a contract? Where is that contract? What are the terms? What are you paying now? What do you expect to be paying in the future? When you work with us and eXitSystems, we get all that lined up. It's not necessarily AI to put that together. It's AI and people and data and software on the back end to analyze the expenses. But to answer that question more specifically, Charles, when a potential acquirer is looking at the overall set, savvy ones are going to look at their vendor structure, their procurement structure. Is it in order? Do they know, have they properly predicted what they're going to be paying over the next few years? When working with Schooley Mitchell and eXitSystems, they're going to have that answered and they have that at their fingertips rather than going hunting.
Very good. Well, thank you guys for your input. Any final comments before we call this a wrap?
No, thank you for having us.
Yep, thanks.
Thank you, Charles.
Very much.
Yeah, thank you. The input's invaluable. And thanks to everyone who attended, as well as to those who do this as a recording, and hope that you get great value out of it. And if there's anything that you need, that we can help you with your growth, your scaling, and exiting, please reach out to us. You can reach out to me directly at charles@eXitSystemsAI.com. And we certainly appreciate your time. Wish you much success. And thank you guys once again for attending and being on the panel.
You're welcome.
You're welcome. Have a great day.
Have a
All
great
right.
day.
Thank you.